Stop what you're doing. Because if you own bank stocks, or honestly, even if you just track international finance, you absolutely need to see this breakdown. Look, retail investors constantly fear getting left in the dark when institutional money makes a massive move. It always feels like the big players just know something we don't, right? You're sitting there wondering how they caught the wave, while we're left just reading the aftermath. But what happens when a relatively under-the-radar island bank quietly posts a return on equity that completely eclipses the biggest players on Wall Street and then suddenly drops nearly $1.8 billion in a single deal to buy up the competition? It is literally like watching a quiet chess player suddenly sweep half the pieces off the board in one move. Last week, I ran this exact bank's recent SEC filings and earnings reports through our deep fundamental analysis framework. I was evaluating it against a classic Peter Lynch-style checklist for aggressive regional expansion, looking hard at their net interest margins, dissecting their capital ratios, and tracking real-time insider buying to see exactly where the smart money is flowing. And I have to tell you, what I found genuinely shocked me. To give you a clear, actionable framework you can essentially steal and use to evaluate this stock or any regional bank making a major acquisition, I've laid out all the raw data. By the end of this explainer, you will know exactly if this aggressive power play is a masterclass in Caribbean banking dominance or a massive value trap waiting to spring. Okay, let's dive into this.
To figure that all out, we're going to break this complex banking expansion down into 5 simple objective parts. Here is our roadmap. First, we'll dissect that $1.8 billion power play that just hit the wires. Second, we're going to look at the fundamental Q1 earnings actually funding the massive expansion. Third, we'll follow the insider money to see a crucial market signal from a top director. Fourth, we'll uncover the unique Bermuda tax advantage, giving them an edge over mainland peers. And finally, we will look at Wall Street's ultimate verdict. Let's get right to it.
Section 1. The $1.8 billion power play, the acquisition of CIBC Caribbean.
So, in late May 2026, Butterfield announced an absolute blockbuster acquisition. To really understand the gravity of this move, you have to look at the sheer scale of the transaction. Butterfield is paying a massive $1.794 billion to acquire a controlling 91.7% stake in CIBC Caribbean Bank from its Canadian parent company. With CIBC Caribbean holding about $29 billion in assets, this single transaction is designed to drastically expand Butterfield's wealth management and banking presence across multiple island markets, basically in one fell swoop.
Now, what's really interesting here is how Butterfield is choosing to pay for this massive acquisition. They aren't just diluting their stock to the moon. Look at the deal split. 61% of it is structured as cash, which is a hefty $1.091 billion. And 39% is in Butterfield shares, which equates to about $703 million. Now, to fund that heavy cash portion and to maintain a targeted 19% total capital ratio at close, Butterfield intends to issue $700 million in Tier 2 subordinated debt. It's a highly calculated financing structure, and it shows immense confidence in their future cash flows.
And when we look directly at the official transaction overview from Butterfield's May presentation, we can see exactly why they are so confident. These two institutions have highly complementary geographic footprints with very limited overlap. This means they can maintain both organizations' operational hubs, including CIBC Caribbean's regional headquarters down in Barbados. Even better, they already operate on similar IT systems, which severely reduces the usual headaches of integration complexity. Because of this smooth overlap, Butterfield expects to realize approximately $49 million in annual pre-tax cost synergies, which will be phased in over 4 years.
Section 2. Funding the expansion. Q1 2026 Core Fundamentals.
You can't just drop $1 billion in cash without a rock-solid foundation. Let's walk through this granular quarterly data. For the first quarter 2026, Butterfield reported a net income of $62.6 million, which is up significantly from $53.8 million a year earlier. Diluted earnings per share hit $1.53. Furthermore, their net interest margin actually expanded to 2.75%. Driven by falling deposit costs and higher yields on their investment securities. The bank also kept expenses tightly controlled, bringing their core efficiency ratio down to 56.4%. But the absolute standout metric here, the one you really need to pay attention to, is their return on average common equity, which came in at a staggering 22.1%.
And this brilliantly illustrates just how impressive that 22.1% really is. When you anchor Butterfield's return on equity against a massive industry benchmark like Bank of America, which reported a 12% return on equity during the exact same period, the contrast is stark. Butterfield is operating with incredible profitability. It's this exact operational efficiency that allows them to pay out a 50-cent quarterly dividend, execute a $140 million share repurchase program, and still have the firepower to go out and acquire CIBC Caribbean.
Section 3.
Following the insider money, Director Mark T. Lynch's market signal.
Okay, so the macro picture is clearly strong, but what about the micro level? As the saying goes, insiders have millions of reasons to sell their stock, but historically, there's really just one reason they buy. Look at how this timeline unfolds. It perfectly maps out the sequence of events. In April, Butterfield releases those stellar Q1 earnings we just talked about. By mid-April, they close a separate acquisition of Rawlinson & Hunter Guernsey, adding $9 billion in client assets to their trust business. Then, on May 28th, the massive $1.8 billion CIBC Caribbean deal is officially announced to the public. And what happens the very next day? On May 29th, Butterfield director Mark T. Lynch steps into the open market and purchases a massive block of shares.
Let's detail the specific metrics of that SEC Form 4 filing. Lynch acquired 10,000 shares directly at an average price of $56.49. That is a total transaction value of nearly $565,000 of his own money. This purchase increased his direct holdings by 4.45%, bringing his total direct ownership to 234,794 shares. It is absolutely crucial to note that these are pure, direct equity holdings. No indirect ownership, no derivative options. This is a clear, objective signal of an insider who intimately knows the details of the CIBC acquisition, choosing to significantly increase his personal stake in the company's future.
Let's move to Section 4 and see how this builds into their broader environment. The Bermuda strategic advantage, tax incentives, and macro environment.
The truth is, Butterfield isn't just succeeding based on good management, they're benefiting immensely from the unique legal and tax frameworks of their home base. Acting as an international bank headquartered in Bermuda, with deep historical and financial ties to the UK and Canada, provides an incredible regional advantage. Bermuda is a major global hub for insurance, reinsurance, and multinational corporate holding companies. Managing the trusts, wealth, and corporate deposits of these massive entities provides Butterfield with an incredibly stable and lucrative revenue stream that traditional mainland retail banks simply do not have access to.
And the macroeconomic environment there is evolving to protect that exact status. Recently, Bermuda enacted the Corporate Income Tax Act to align with global minimum tax standards. But to maintain the island's attractiveness for multinational businesses, the government also tabled the Tax Credits Act 2025. This legislation establishes robust credits, like the Community Development Tax Credit, that organizations can utilize to significantly reduce their corporate income or payroll tax liability. These dynamic legislative moves essentially ensure that Bermuda remains a premier financial hub, which directly secures Butterfield's core client base for decades to come.
Finally, Section 5, Wall Street's verdict, analyst sentiment and market forecasts.
So with a $1.8 billion acquisition, sector-beating returns, heavy insider buying, and a protected tax advantage, how is the market actually digesting all of this? So the crucial point is right here in the consensus targets. Wall Street maintains a largely neutral to positive sentiment on Butterfield. Out of the top analysts recently surveyed, the median price target sits at $60.00, with a high estimate of $63 and a low of $57. With the stock trading around that $57 to $58 range recently, that median target implies a solid upside. Analysts from major firms like Goldman Sachs and Raymond James have reiterated buy and outperform ratings over the last year, recognizing the bank's consistent 3.46% dividend yield and strategic market positioning.
Which leaves us with this final thought. Butterfield is no longer just playing defense, they are aggressively consolidating the market. With a massive $1.8 billion acquisition of CIBC Caribbean, an incredibly strong return on equity, and a director willing to put over $500,000 of his own money on the line the literal day after the deal is announced, how will Butterfield's strategic moves reshape the entire Caribbean banking landscape over the next decade? It's a fascinating question, and for sure, one we'll be watching closely. Thank you for joining me for this explainer. Keep learning, and I'll catch you next time.